Ganesha Ecosphere is a machine operating under heavy friction. The outer gears are grinding, yet the primary drive shaft continues to turn without hesitation. This internal friction is evident in the company's trailing financial results. In the third quarter of fiscal year 2026, the company reported an 84. As of March 20th, 2026, the stock is trading at 820 rupees and 5 paise. This puts the company's total market capitalization at approximately 2,240 crore rupees. This current price represents a steep discount from the 52-week high of 1,742 rupees and 30 paise. After retreating from those previous highs, the stock has entered a volatile consolidation phase. The downward velocity has slowed, but the price continues to bleed out as buyers remain hesitant. The market is in a holding pattern. Investors have priced in the recent financial damage, and capital is now waiting for verifiable proof of a turnaround before re-entering the asset. This daily candlestick chart illustrates Ganesha Ecosphere's recent price action, reflecting the broader market's exact uncertainty. We can see the persistent downtrend transitioning into recent choppy, sideways movement. The immediate pivot point sits at exactly 847 rupees. A pivot point is an indicator used to determine the overall trend. The stock is trading below this level, treating the 847 mark as a hard ceiling. Above that pivot, specific resistance zones are capping upward momentum. Resistance 1 is at 865 rupees, resistance 2 at 885 rupees. Recent daily candles failed to break higher, while a flat RSI indicates a lack of buying momentum. Consequently, the technical sentiment remains neutral to bearish. Until trading volume expands and the price can sustain a verified close above the 850 rupee threshold, the chart remains under pressure. The technical ceiling is a direct reflection of institutional hesitation regarding the company's underlying earnings. To find the source of that hesitation, we have to examine the quarterly ledger. This table displays the detailed quarterly profit and loss statement. By isolating the line items, we can pinpoint the exact origin of the weakness. First, we can rule out a collapse in demand. Looking at the top row, top-line revenue has remained stable. Over the last 3 recorded quarters, sales hovered between 337 and 363 crore rupees. The product is still moving. The actual crisis is located further down the sheet, a severe compression of the OPM, or operating profit margin. This percentage measures how much profit a company makes after paying for variable costs of production. Notice the sharp drop from 10.76% down to 6.14% before managing a weak recovery to 8.60%. When you track this margin squeeze down to the bottom line, the math becomes punishing. Static operational costs eating into shrinking margins resulted in a negligible net profit of just 4.75 crore rupees for the December quarter. This is operational leverage working in reverse. When a manufacturing company carries heavy fixed costs, even a small contraction in profit margins at the top creates a disproportionate collapse in net earnings at the bottom. The 84% profit drop is an internal margin crisis driven by rising operational costs. This realization refocuses the valuation on the company's ability to regain its historical operational efficiency. If the margins are currently crushed and earnings are flat, what exact asset is Wall Street valuing to justify that aggressive 1,242 rupee target price? This document from the company's corporate profile reveals the primary driver of the bullish thesis: sheer infrastructural scale. Ganesha Ecosphere commands a cumulative capacity of 1,018,800 tons per annum, spread across 3 major plants. This includes over 108,000 tons of recycled polyester staple fiber, a specific output requiring massive capital expenditure. That infrastructure sits directly in the path of a major macroeconomic tailwind. Global textile manufacturers are moving to replace virgin plastics with recycled PET, or rPET, in functional fabrics. The scale of this physical operation provides a stark contrast to the small numbers on the recent quarterly statements. The capability to process these volumes nationwide is already built, permitted, and operational. Analysts maintaining high price targets are looking past the trailing margin squeeze. Instead, they are pricing in the steep replacement cost of this pan-India footprint and the revenue it will generate once the pricing cycle normalizes. This brings us to the most frequently cited warning sign for the stock: its currently bloated trailing 12 months price to earnings, or PE ratio, sitting at 57.81. The PE ratio measures a property's current share price relative to its per-share earnings. A PE of 58 typically indicates an overvalued stock. However, in this case, it is a mathematical artifact. Because the earnings, temporarily collapsed due to the recent margin squeeze, the ratio mechanically spiked. It measures the recent trough, not the baseline value. We can verify the underlying financial safety by checking the balance sheet. The company maintains a healthy debt-to-equity ratio of 0.43. This metric, which evaluates how much a company finances its operations through debt versus wholly owned funds, shows highly manageable leverage levels. Furthermore, the price-to-book ratio, comparing the market capitalization to the actual accounting value of its assets, sits at a reasonable 1.77. Ganesha Ecosphere retains a healthy balance sheet, indicating the company is well positioned to weather this temporary cyclical profitability headwind. The fate of the stock over the next 3 years hinges on a single master metric, return on equity, or ROE. This measures how efficiently a company generates profits from the capital its shareholders have invested. This chart projects the required return on equity expansion. To justify the 1,242 rupee target, ROE must expand from 5.05% to 13% by 2027. Bridging this gap requires 2 variables. Reinvested earnings must yield operational efficiency, and cyclical cost pressures must stabilize. The 1,242 rupee target price is mathematically sound, but only if the company can definitively prove that the current margin compression is a temporary cycle and not a permanent structural flaw in their business model. Right now, Ganesha Ecosphere is a story that requires verifiable proof. The physical infrastructure is unmatched, but the market demands a recovery in profit. In the immediate short term, the stock will likely remain technically capped, struggling to break through the 850 to 865 rupee resistance band without a fresh catalyst. The ultimate trigger to monitor is the operating profit margin. Subsequent quarterly reports must show a verifiable recovery in the OPM percentage to validate the bullish long-term thesis and bring institutional volume back to the asset. Ganesha Ecosphere is a battleground asset. The market is actively weighing the pain of short-term fundamental costs against the immense value of long-term infrastructural scale.